Dollar Tree stock just surged over 40% in only 13 weeks.
Which is a massive move for a legacy retailer.
Right. But here is the crazy part. The analysts who actually get paid to rate this company, they are telling everyone to wait. They have it sitting at a hold.
Yeah, the disconnect there is wild.
It really is. And while the stock is flying high on Wall Street, the corporate insiders running the company have quietly sold off nearly 13 million shares.
And they haven't bought a single one back.
Not one. Welcome to the Deep Dive. Today, we are unpacking a massive turnaround plan, a giant financial red flag, and, well, a real-time test of a legacy business fighting for its life.
It's just a fascinating dynamic. We're looking at this extensive equity research report from OxAlpha, and it's dated August 23, 2026.
So really recent data.
Exactly. And the reason this matters right now, why this is such a critical moment for you to watch, is that we're just days away from a massive binary event. Dollar Tree reports its fiscal Q2 earnings on August 27.
Right. And for you listening, we aren't going through this report to give you, like, a stock tip.
No, not at all.
This is a masterclass in retail survival. We are looking at how a multi-billion-dollar company tries to rebuild its economic engine, all while the entire market is scrutinizing every single quarter.
Because turning around a massive physical retail chain isn't just about, changing a logo or running a new ad campaign.
Yeah, that doesn't fix the underlying math.
Right. It requires shifting consumer behavior, managing these incredibly complex global supply chains, and somehow making the math work on extremely cheap items.
Especially when the cost of literally everything else in the world is going up.
Exactly.
Okay, let's unpack this. Because to understand where Dollar Tree is heading on August 27, we first have to figure out what actually sparked this 40% rally.
Yeah, we have to look at the catalyst.
Right, because the stock was basically flatlining, and then suddenly investors are just pouring money into it. Why?
It comes down to one single metric, and it's the metric that every physical retailer lives and dies by.
Foot traffic.
Foot traffic. The initial spark for this whole rally was an upgrade from the investment bank Jefferies.
Oh, interesting.
Yeah, they raised their outlook on Dollar Tree entirely because their data showed the company was hitting its strongest store traffic in 9 quarters.
Wait, 9 quarters? That is over 2 years of data showing a sudden, sustained increase in actual human beings walking through the doors.
Yes, and analysts track this using a concept called comparable store sales, or comps for short.
Let's define that really quickly for the listener, because I see that term everywhere in retail research. Comps just means you're measuring sales only from stores that have been open for at least a year.
Exactly. I mean, if a company just opens 100 new stores, their total revenue will obviously go up.
Sure, just by sheer volume.
Right. But that doesn't tell you if the business is actually healthy. Measuring comps strips away the new stores and tells you if the core existing business is growing or shrinking.
That makes total sense.
And what Jeffrey saw was a traffic-led comp recovery.
Meaning existing Dollar Tree stores aren't just making more money because they hiked up prices.
Exactly. They're making more money because more individual shoppers are coming in.
And the research notes actually point out that this isn't just happening in a vacuum, right? Like, the broader value retail sector seems to be catching a wave.
Yeah, they specifically highlight that Ross Stores, another major discount retailer, they just posted a very strong Q2 beat driven by higher traffic.
But I want to stick with Dollar Tree for a second.
Right.
Why is foot traffic such an explosive catalyst for the stock price?
Well, it's because of how the underlying math of a physical store works. When you run a massive network of retail locations, your fixed costs are incredibly high.
The baseline expenses to just exist.
Right. The rent for the building costs the same whether one person walks in or 1,000 people walk in. The electricity bill is the same. The manager's salary is the same.
Let me test an analogy here to make sure I'm visualizing this correctly. It feels very similar to operating like a commercial airline.
Oh, I like that. Let's hear it.
So if an airline flies a plane from New York to LA, the cost of that flight is basically locked in before the doors even close.
Right, the sunk costs.
Exactly. They have to pay for the jet fuel, the pilot's salary, the airport gate fees, and if they fly that plane half empty, they bleed money.
Absolutely.
But once they sell just enough tickets to cover those baseline costs, every single extra ticket they sell after that is almost pure profit, dropping straight to the bottom line.
That is the perfect way to look at it. And the financial term for that mechanism is fixed cost leverage.
Fixed cost leverage. Okay.
So when Dollar Tree hits a 9-quarter high in foot traffic, those extra shoppers are the additional passengers on your plane.
Oh, wow.
Because the lights are already on, right?
Right, yeah.
The staff is already paid. So the profit margin on the items those extra customers buy is significantly higher.
So on paper, more traffic equals a disproportionate jump in profit.
Yeah, and what's fascinating here is how that single mechanic forces Wall Street's hand. Even after the Jeffries upgrade, the consensus rating on Dollar Tree is still a hold.
Which seems contradictory.
It does.
Yeah.
But if this foot traffic is real and if it's durable, analysts will have no choice but to revise their earnings estimates upward.
And when Wall Street starts officially predicting higher earnings, institutional money usually just floods in.
Exactly. That's the momentum we're seeing.
Okay, so that makes sense in theory. You get more people in the door, you cover your fixed costs, and the extra cash falls to the bottom line.
In theory, yes.
But my question is, does that actually happen in reality? Let's look at the actual cash, because the Q1 financial data in this report tells a very different story.
Yeah, it is a sobering set of numbers, to say the least.
Let me do the math for you listening, because this is where the turnaround narrative just hits a brick wall. In Q1, Dollar Tree's top-line revenue hit almost $4.97 billion.
Which is huge.
Right. That's a 7.3% increase compared to the previous year. That proves the traffic is there, people are buying things.
The top-line growth is very solid.
But then you look at the net income, the actual profit they get to keep. Net income for that quarter was $347.3 million.
Yeah, out of nearly $5 billion in revenue.
And that is only a 1.1% increase from the year before. So wait, they're bringing in nearly $5 billion, but they only get to keep less than $350 million.
That's the reality of their margins.
But they worked hard enough to grow revenue by 7.3%, and their actual take-home cash barely moved. It feels like they're just running on a treadmill at max speed just to stay in the exact same place.
You're describing the absolute core vulnerability of the discount retail model.
It's just wild.
They operate on a razor-thin trailing 12-month net margin of just 6.51%. Think about the mechanics of that.
Less than 7%.
Yeah. For every $100 a customer hands over to the cashier, Dollar Tree only keeps about $6.50 in profit.
That is terrifying. If one little thing goes wrong in the supply chain, that $6 vanishes.
And things are going wrong, which is why the research report lists tariff pressures and wage inflation as major active bear concerns.
Ah, okay, the macro stuff.
Right. Dollar Tree relies heavily on importing incredibly cheap goods from overseas to maintain those extreme value price points.
Right.
So if new global tariffs are introduced, their cost to buy that inventory goes up. But they can't easily raise the price on the shelf.
Right, because their whole identity is tied to the price.
Exactly. If you're famous for selling things for $1 or $1.25, you can't just suddenly charge $1.50 without alienating your core customer.
So they just have to eat the cost.
Eat the cost. And simultaneously, the domestic labor market is tight. They have to pay their store associates higher minimum wages just to keep the doors open.
Right.
So going back to your airline analogy, you have more passengers on the plane, which is great, but the cost of jet fuel just doubled, and the pilot just demanded a massive raise.
Oh, that hurts.
The top line is growing, but the expenses are growing faster.
Which brings us perfectly to the internal strategy. Because management can't just wave a magic wand and change international trade policy.
No, they can't.
And they can't illegally lower wages. So if they're going to fix this margin squeeze, they had to do it from inside the building. The report focuses heavily on what it calls self-help strategies.
Yeah, and self-help is just Wall Street shorthand for the operational levers a company can pull entirely on its own. They aren't waiting for the macroeconomy to save them.
The sources detail two massive self-help levers. The first is a major reshaping of their store portfolio.
Closing the losers, opening new winners.
Right. In 2026, they're planning to open roughly 400 new locations, but they're also closing about 75 underperforming stores. They're actively pruning the dead branches.
Which is standard, but necessary.
But the second lever is the one I want to dig into, because Jeffries highlighted it as a key driver. It's a push for simpler operations.
That is arguably the most critical piece of the turnaround.
But what does simpler operations actually mean on the ground? It sounds like corporate jargon. If they start stocking fewer items to make things simpler, don't they risk pushing customers away to competitors who actually have what they want?
That is the risk. But let's look at the mechanics of how complexity drains cash in a retail environment. Let's say Dollar Tree currently stocks 15 different types of generic cleaning spray. That means their suppliers have to manufacture 15 different labels.
Right.
The distribution centers have to sort and track 15 different barcodes. And when the delivery truck arrives at the store, the minimum wage employees have to spend hours in the back room breaking down these complex pallets.
Oh, finding the right boxes, organizing them on the shelf.
Exactly. It's a massive drag on labor hours.
I didn't even think about the backroom labor.
Every single touch point costs time, and time is wage money. So if management aggressively prunes that category down to just the 3 best-selling cleaning sprays, the pallets arrive at the store uniform.
And the employees just grab it and go.
Right. They can pull the box straight off the truck and put it directly on the shelf in 5 minutes instead of an hour. The inventory is easier to track, there's less damaged product in the back room, and the supply chain becomes vastly more efficient.
Here's where it gets really interesting, because Wall Street analysts are actually buying into this unglamorous backroom optimization.
They love it.
The report notes that analysts at Oppenheimer expect Dollar Tree's management to literally lift their full-year outlook at the upcoming August 27 print.
Which is a huge signal.
Right. They believe this specific internal cleanup is working so well that the company will announce they're going to make more money this year than previously expected.
If we connect this to the bigger picture, it explains exactly why investors are so willing to bid this stock up 40% even while it's still rated a hold. The market values self-help margin improvements way more highly than macro tailwinds.
Why is that, though? Isn't profit just profit?
Not to an investor. If your profit margin goes up because, say, global shipping rates temporarily crashed for 6 months, investors know that is fleeting.
Because the shipping rates will eventually go back up.
Exactly. But if your profit margin goes up because you permanently redesigned your supply chain to require 20% less labor at the store level,
Oh, that sticks around.
that is credible. That is repeatable. You have built a structural floor under your future earnings.
Okay, so we have a clear bullish narrative here. We have 9-quarter high traffic, we have 400 new stores opening, and we have a hyper-efficient supply chain strategy that might lead to a raised outlook. It sounds fantastic.
It does.
But if this strategy is so bulletproof, why are the insiders sprinting for the emergency exits?
The SEC transaction data. This is where the story gets very complicated.
According to the filings reviewed in the Ox Alpha report, the executives and directors inside Dollar Tree recently executed 12 open market sales, dumping a total of 12.8 million shares.
A massive chunk of equity.
And the number of open market purchases by those same insiders, 0. Absolute 0.
Yeah.
So the people with real-time access to the daily sales data have sold nearly 13 million shares into this 40% rally right before a massive earnings report, and no one is buying. How is that not a blaring siren?
Well, you have to be careful with insider data, but you are absolutely right to view it with extreme caution. To be clear about the mechanics, corporate executives are often paid in stock.
Right, it's a huge part of their compensation.
Yeah. And they routinely sell shares to pay taxes, buy real estate, or just to diversify their wealth so they aren't entirely dependent on one single company.
Makes sense on an individual level.
And the SEC requires them to disclose these sales publicly, but they don't have to explain why they are selling.
Right, but 12.8 million shares and 0 buys.
That is the issue. The optics are undeniably terrible. A scheduled sale of 50,000 shares is normal diversification. But when a stock surges 40% in just 13 weeks entirely on the hope of a turnaround, and the insiders aggressively cash out without a single purchase,
It's just a bad look.
it's a very heavy countersignal. It implies that the people inside the building might believe the stock price has gotten way ahead of the actual business recovery.
And it's not just the insider selling that is flashing red. The sources bring up a massive macroeconomic warning light, too.
Oh, the Walmart data.
Yeah. They note that Walmart recently posted weak U.S. sales and issued cautious guidance. That sent a shockwave through the market about broad consumer spending.
Right, Walmart is the bellwether.
Exactly. If Walmart is worried, the American consumer might finally be tapped out. But I want to challenge this a bit.
Go for it.
If a middle-class family is tapped out and they can no longer afford to fill up a cart at a traditional grocery store, don't they trade down? Doesn't a struggling consumer actually help a deep discounter like Dollar Tree?
You're describing the classic counter-cyclical theory of discount retail.
Which makes logical sense, right?
It does. The idea is that extreme value models have a built-in cushion during a recession. People might delay buying a new television, but they still need toothpaste, paper towels, and school supplies.
Right, they just drop down a tier and buy them where they're cheapest.
So bad news for the economy could be good news for them.
Exactly.
In theory. But the research report is very explicit in pushing back on this. They say there is absolutely no confirmed evidence of downturn resilience for Dollar Tree in this current cycle.
Wait, really? None?
None. It is purely an assumption right now. You cannot just blindly assume that a stressed consumer helps them, because if a low-income consumer is truly tapped out by inflation, they might not just trade down, they might simply buy fewer items overall.
Oh, I see.
And if we go back to that razor-thin 6.51% net margin, if their total sales volume drops even slightly, that margin gets completely crushed.
Wow. So management is really walking a tightrope in a windstorm.
Yeah.
We have this bullish, traffic-led recovery fighting against bearish insider selling and a shaky consumer.
It's tense.
Which brings us to the upcoming catalyst on August 27th. The research report maps out a few paths forward. First, let's look at what they call the blue sky scenario.
The best case.
And to be crystal clear for you listening, as the sources note, this is an optimistic framework. We are not making predictions here.
Right. This is an analytical exercise. We're asking what happens to the math if management executes perfectly.
So in that blue sky scenario, the foot traffic proves durable. The 400 new stores open on time and start generating cash.
Right.
The simpler operations successfully defend against the tariff pressures, and their profit margin actually expands.
If they do all of that, the market narrative completely flips.
Yeah, they stop treating Dollar Tree like a messy turnaround, and they reclassify it as a durable compounder. The report notes the stock is currently trading at a 19.35x trailing PE ratio. Let's translate that for a second.
Sure. A PE, or price-to-earnings ratio, is simply how much investors are willing to pay for $1 of a company's profit.
Right. So right now, investors are paying roughly $19 for every $1 Dollar Tree earns.
Exactly.
But if they hit this blue sky scenario, what happens to that multiple?
It expands. If the market believes a company is no longer struggling, but is instead a highly efficient, growing machine, a durable compounder investors will pay a premium.
Oh, so the math changes completely.
Yeah, they might be willing to pay $24 or $25 for that same $1 of profit. When that multiple expands, the stock price re-rates significantly higher, even before the company actually makes any extra money.
That's wild.
In fact, the report references Guru Focus, which uses an intrinsic value framework to estimate the stock might already be 11.8% undervalued.
But this raises an important question, and it is the immediate hurdle we face on August 27. Has this 13-week, 40% rally already priced in that blue sky scenario?
That's the million-dollar question. The expectations have to be sky high.
Right. They are incredibly elevated. Analysts are expecting Q2 revenue to hit $4.85 billion, with earnings per share between $1 and $1.15.
So they can't just have a decent quarter.
If they come out and just meet expectations, an inline quarter, is that enough?
It might not be. If they just meet expectations and they don't raise their guidance for the rest of the year, this entire re-rating process could violently stall.
Because the market already gave them credit for a perfect quarter.
Exactly. The momentum buyers who drove the stock up 40% might look at the print and say, we gave you a massive premium, we ignored your insiders selling 13 million shares, and this is all you have. If the actual financial results don't confirm the hype, those buyers will unwind their positions very quickly.
So what does this all mean for you listening? It means Dollar Tree is standing at one of the most fascinating high-stakes crossroads in the retail sector right now.
Truly.
On one hand, you have a business with the strongest foot traffic in over 2 years, executing a massive fleet reshaping plan, and aggressively simplifying its backroom operations to defend its profits.
A lot of positive.
But on the other hand, you have a legacy model fighting for its life against razor-thin margins, persistent wage inflation, the looming threat of global tariffs, and of course, the ominous shadow of its own executives, selling off millions of shares right before earnings.
It is the ultimate real-time test of corporate execution versus market expectation.
And as you watch this play out on August 27 and beyond, our expert has one final macro-level thought for you to mull over.
Yeah, I want you to think about this from a broader perspective. If a deep discount retailer's ultimate optimistic blue sky scenario relies heavily on American consumers being so deeply budget constrained that they are literally forced to abandon their traditional grocery stores just to make ends meet. What does a booming Dollar Tree actually signal about the financial health of the everyday consumer?
That's dark.
If this turnaround is wildly successful, are we cheering for a great corporate comeback, or are we just witnessing the very visible symptoms of a heavily stressed middle class?
That is a phenomenal question to keep in mind. When you are tracking how a business operates, the mechanics of how it makes its money tell you a lot about the economy it operates in.
Mhm.
Thank you so much for joining us on this deep dive into the numbers, the strategies, and the risks. Stay curious, keep learning, and we'll catch you next time.